This is Financially Fit Business with Ruth King.
Welcome to the Financially Fit Business Podcast. Here you discover ideas, tactics, news, and information that matters to the health of your business or your clients' businesses. I'm your host, Ruth King. Here is how we will help you increase the financial fitness of your businesses today. In the previous episodes, I gave you the first 5 parts of a financially fit business: tracking, looking at overhead costs per unit of revenue and net profit per unit of revenue, pricing, recurring revenue, and metrics. In this episode, I'll discuss Part 6, budgeting. Let's get started. Budgeting is an interesting thing to do because my thoughts are if you don't plan and you don't budget, you're going to get somewhere, but it may not necessarily be where you want to go. So I look at budgets as being very dynamic, and I look at them probably differently than most people look at them. When I'm creating a budget, I start at the bottom and I work up. Think about it. It's 2026 almost, and you're planning the budget for 2026. What do most people do? This year I did X number of dollars in revenue. Next year I want to do 10% more or 15% or more. And you start at the top and go down. And I'm not sure that's the right way to budget. My sense is, okay, how do you generate revenue? And we've talked about, overhead costs per unit of revenue and net profit per unit of revenue in previous episodes. But, for whatever your unit of revenue was, how many units did you have this year? And if you weren't happy with the number of units that you had this year, then we need to figure out how many we want next year. And I'm going to take a very simplistic example. I'm going to take a car wash, because all of us really and truly understand, taking your car through a car wash and cleaning it, right? So if the car wash, the unit of revenue for revenue generation is how many cars went through the car wash. So let's say this year in this particular year, we had 1,000 cars go through the car wash. And if only 1,000 cars go through the car wash, guess what? We know that they're not making any money, but I want to use this as an example. So we know that we did 1,000 cars going through the car wash this year, and we figure that we could increase capacity by X. Let's say we can increase capacity by 20% this year and not have to add any infrastructure. So instead of 1,000 cars going through the car wash next year, where do we look at it? We add 20% capacity, so we make it 1,200 cars going through the car wash next year. We know what the overhead cost is per car, and we multiply that by 1,200, and so that we get our total overhead costs. We then have our gross profit, and then we know what our direct costs are for water and employees and all that sort of fun stuff. And then we have our revenue that we have to generate for the car wash. Okay, I mean, that is a very simplistic way of going backwards, rather than just saying I want to add 5% this year or 10% this year. Look at how you generate the units of revenue and work backwards from them, from that point. Then the next thing to do is if it's a seasonal business. So car washes, as a general rule, if you're in an area where you need to wash your car every single week or whatever else it is, you're not going to have a whole lot of seasonality. But if you're a heating or air conditioning company, you're going to be busier when it's cold and you're going to be busier when it's hot. So whatever the seasonality is, you take that revenue number that you just generated from the bottom and take it by and multiply it by the percentage of revenue that you should generate every single month. So if we said that we had to generate $100,000 in revenue, and in January we produce 5% of the revenue of the year, we take 100,000 times 5%, or 5,000. That's what we do. And then you do it that way to put together your budget. So it's a very, very different way of looking at budgeting. It's looking at budgeting from the bottom up. And until you understand or your clients understand how they generate revenue, they're almost always going to take the revenue and start there and go down. And then if they don't like their net profit per unit of revenue, you basically have to start over again. Why not start at the bottom and work up? Because that makes life a little bit easier, and you only have to do it once. The interesting thing is calculating the overhead cost per unit of revenue, and we've talked about that in previous podcasts. So if you look at the revenue from that perspective and going up, that gives you a much different way of looking at the budget. Okay, here's one other thing that I want to talk about before we take a break, is that after the break, we're going to get into the implementation of it very, very strongly and how I actually implement budgets rather than looking at necessarily what you see on a monthly P&L report. So, normally what I see is we'll have the month P&L and we might have year-to-date P&L, or we'll have the month-to-date P&L, the month-to-date budget P&L, year-to-date P&L, year-to-date budget P&L, and you've got 4 columns of numbers. So clients as a general rule, people as a general rule, unless they're CPAs, financial people like we are, don't get the numbers. They get graphs and they get pictures and being able to look at it from that perspective. And 1 month against budgeted and a year against, where we are year to date doesn't really tell you what you have left in that budget for the remainder of the year. So I look at budgeting a little bit differently for implementation so that you can actually see graphs and you can actually see numbers in much more of a visual format. So after the break, I'm going to give you my version of how I implement and how I help clients with the budgeting process. We'll be right back. Thanks for listening to the Financially Fit Business Podcast.
Thank you for listening to Contractor Sense. Here's my holiday gift for you. Try Financially Fit Business. Put 2 years of your monthly financial statements in the software and see what they're telling you. We'll take you through the process and review your financial graphs with you on a Zoom call. Make sure that your company is financially healthy starting the new year. Your investment, only $299. Call me at 770-729-0258 or Ruth King at hvacchannel.tv. I'll send you the simple list of what you need to send me. If you are using QuickBooks Online as your accounting software, you don't have to send me anything. This is an $800 value for only $299. You save $500. Hurry, this offer expires January 15, 2026. It might be the best investment you make all year.
We're back. Thanks for listening to the Financially Fit Business Podcast. Before the break, I gave you how I do budgeting, starting from your unit of revenue and how many of those units you actually generated this particular year, and then looking at it and going up the P&L rather than starting at revenue and adding percentages and going down the P&L and potentially not liking the numbers. So the other thing that we talked about before the break was most of the times when I see reports, I see them as, month to date, year to date, or month to date budget, or month to date budget, year to date budget, which tells you nothing about how to use the particular budget. It only tells you where you are for that particular month and whether you hit budget, or where you are for year to date and where you hit budget. It doesn't tell you how much is left. It doesn't tell you, things that are important to know, that you might be spending not the same amount of money every single month. So for example, if you have property taxes, they're due once a year generally. And so you have 0, 0, 0 in the budget and then a big number to pay the property tax and all zeros. But if your budget shows, it's February and the taxes are due in July, you're showing 0 and 0, but you don't know in the back of your head how much the taxes are supposed to be. So when I look at a budget, and you have the entire year, all, from the revenue side and the cost of goods sold side and the overhead side. And it will be different numbers for different months unless it's your rent and it's the same amount of rent every single month. That one's easy. Or, an average for the utility bill, but the utility bill is about the same month. That's pretty easy too. But if you're doing marketing type things, or you're doing things that, come about once or twice a year, Or you may be doing marketing from a perspective of increasing marketing when people are paying attention and decreasing marketing when people aren't paying attention, advertising marketing, whatever. It makes life a little bit different and a little bit difficult. So what I normally do with a budget is I have the whole year. And then what we end up doing is we do a thing called budget versus actual. And there's another column on the back side after we have the budget total. And then actual is what happens when we actually start putting the true numbers into the budget. And so here's what I mean. What we'll do is we'll take January's actual data off the P&L and we'll put it into our budget. And then the budget will recalculate to look at the actual if we make budget for the rest of the year. So for example, from the revenue side, if we've budgeted $100,000 in revenue and January was supposed to be $5,000, and January turned out to be $4,280, the actual year to date under actual will not be $100,000 anymore. It will be it'll be the 4,000 whatever it was, and then the actual budgeted numbers there. It will be less than the budgeted number that we had. So we have to look at it and say, okay, it was January. Are we going to make up this deficit that we had in January to go forward and make sure that we make our budget by the end of the year? 1 month is kind of hard because it's only a month, and January sometimes is a crazy month for a lot of businesses. If you're into the budget, 3, 4, 5, 6 months, and your actual revenue number is, and I've had this happen, we've budgeted, $2 million for revenue, and by June, we're only at $500,000. You have to take a look at, all right, do we redo the budget, or is there a way that we're going to make up the amount in the next 6 months? So that's the hard way to do it. It's really interesting. I worked with a client many years ago, and we did their budget. And they had made the entire budget in the first 6 months, right? Murphy went to sleep. Everything went perfectly. It was like nirvana. I don't know any other way to describe it. And so we're into June, and we've made budget for the year, both from a revenue and a net profit perspective. And they're going, oh, goody, we can coast the rest of the year. I went, no, we're redoing the budget. So we redid the budget. And that just perfect. They made the remainder of the budget by November with November's numbers. And I said, okay, we don't have to redo the budget for December. We'll just look at it and say that we had one phenomenal year. And it's the only time in 40 plus years that we've actually made budget twice. And, we did what we thought was realistic, but it was just amazing how everything fit into place. The customers fit into place. They got more customers. The people that they needed to produce those particular revenues all magically came to the company. And I'm not kidding. It's happened once in 40 years. So I know that it can happen. It doesn't happen very often. But, if you're looking at budget and you're so far ahead of budget from a revenue perspective and you're all the way down the line to the net profit, it's time to redo the budget. And your clients are going to gripe about it because they feel really good. They made budget for the year. And what are they going to do? Slack off for the rest of the year? I don't think so. So that was an interesting conversation. But they understood why we needed to redo the budget, because we needed the roadmap to go for the rest of the year since the first part of the year had been that good. So occasionally that happens. More often, and I see it the flip side, where we've said we're going to be at $2 million and we're at $500,000 by June. And the overhead doesn't decrease as a general rule, and the profitability at that point probably decreases a whole lot. So start from the bottom with your net profit per unit of revenue. Determine where you are in this year, where you want to be for next year. Work up, and then put a budget versus actual together so that you can make sure that you are meeting budget not only for that particular month, but for the year as a whole. And that's a much better way to have conversations with your clients, because if they're departmentalized, then some of the departments might be over budget, some of them might be under budget, some of them might be way under budget. And so you're going to have a conversation about that particular department. Can you bring it back up to budget? If not, what are we going to do about it? And it actually has the ability to start very in-depth conversations about, well, do we really need this department? If it's not going to make a profit, why do we have this department? So there's a lot of things that you can do when you actually look at budgeting on a year basis rather than just a month to date and a year to date, but actually where you are for the entire year. So that's how I do budgeting. The next podcast on the 7 steps is my final step, financial review, and I'll get that in an upcoming podcast. Thank you for joining us. Choose one thing that you discovered and implement it in your business. These ideas, tactics, and strategies help you make more money, have more free time, and give back. If you like today's program, spread the word. Please review this podcast on any device you're listening to it on. Help a business owner improve the health of his company. For comments or questions, call me at 770-729-8000 or email rking@financiallyfit.business. Thanks for listening. Have a great and profitable day.